So yesterday I had a conversation with a young man and it kind of took me back, so I thought I'd share my story with you today. So first off, my name is Dan Frio. I do a video every day to inform you guys everything real estate. But yesterday I had a conversation with a young man, and at the end of that consultation, he kind of said something or asked me something that kind of took me back. And so I thought I'd share this conversation with you. The conclusion of this was he asked, Dan, would you please not put me into a subprime loan? And please don't put me into adjustable rate mortgage. So as soon as he said that, that kind of took me back, and I'm like, what are you talking about? Because subprime mortgages haven't been around in at least the last 10 years. And he's like, well, I've been trying to educate myself on buying my first house. So I go out to YouTube and I start analyzing all this information that's out there. And everybody keeps saying, the crash of 2008 and, all this other stuff. And I found out enough information that I know one of the things that really caused, the 2008 crash was subprime mortgages. I'm like, okay. So I thought I would share kind of our conversation and at least kind of fast forward you through, educating in the conversation that I had with this young man. So the first thing we want to talk about is what exactly is a subprime mortgage? Okay, how does its rates work? And lastly, what did Congress do or government do to put in place some rules that basically outlawed the loans that were taking place at that time? All right, so let's get to it. The first thing is, what is a subprime mortgage? Well, the one subprime category or program that was abused back in early 2000 was a program called NINA. And the acronym means no income, no assets. So basically, if you had a good enough credit score, you didn't have to prove your income, nor did you have to prove any assets because you didn't really need to put any money down. Okay, so let me walk you through how this works. Back in those days, a 620 credit score would get you into basically a house. It didn't matter if you had any income or if you had any money because you could be placed in that NINA program. Okay, so what it did is we would get your application, we'd pull your credit, we saw that you had a 620 credit score, so we would just issue you a pre-approval because there was really not too much else that we needed to do at that time. Because the administration and the banks all thought, well, everybody deserves to buy a house in today's market because that creates, wealth or generational wealth. Okay, well, that can be but you have to be a good steward of your monies and you have to really know what you're doing. So the subprime program that really was abused back in the early 2000s was subprime mortgages, and the program was called the NINA. Okay, so the next thing we want to go to is how did the interest rates work? Now, this is the intriguing part. Because a lot of those people, we called those loans liar loans because the people didn't really make that much money. But if we denied that person an approval, we could be deemed or fined for redlining. So we didn't want to do that. So we're like, well, the program exists. I can get them approved. So I got to basically put them into this loan. So now we go over to how the interest rates worked. Well, this is also intriguing. All these loans were set up on an adjustable rate. Okay, they were usually 2 to 3 years. So you'd have a fixed rate for about 2 years, and then it would start adjusting. Well, on top of that, you would start out with a below market rate. So let's say the rate was 6.5% at that time. You might get 3.5%. So that would drive down your payment, a couple $100. All right. Then on top of that, for the first 2 or 3 years, all you had to do was pay interest. You didn't even have to make a principal payment. So that also reduced your house payment. It reduced it to the point it was probably about half of what it should have been. Okay, so that's what's going on. So what would happen is after 2 years or 3 years, when your rate started to change, people would call back and say, I need to refinance and get back into that teaser program rate thing that you guys have because I can't afford this payment. Well, house values at that time kept going up and up and up, so it was easy for people to do. Well, what happened in about 2007, 2008 is the housing market topped. Okay, then it started to come down a little bit, just a little bit. All right. So what did you see at that time? Well, you had all the people that were basically their mortgage rates adjusted to the point where now they need to refinance again to go back and put them into that bad loan again. Well, now their house values started to come down. Well, now they can't do it. The reason being is they owed 100% on the house. They never made a principal payment. Then they never put any money down. So what happens is that house price starts coming down. They can't refinance. They can't get back into that bad loan to reset it to a payment that they can afford. So what happens? Well, now their house payment goes from a 3% teaser rate interest only maybe a 6.5% rate where you have to now pay principal and interest. In many cases, the person's house payment doubled. Okay. So then the person's like, okay, I don't know what I'm going to do. I'm going to keep trying to make these payments, but I'm going to put my house on the market. Well, house prices now, you have all these people putting their houses on the market because they're like, okay, I can't afford these payments. I got to get out of this thing before, it's too late. So now house prices start coming down and down and down. And now everybody's just starting to fire sale these houses. So then what happens too is now people are in the position where they owe more than it's worth. Now they're getting offers on their house that's less than what they owe to the bank. So now they're calling the bank saying, hey, will you accept, it's called a short sale. Will you accept a short sale on my house? Meaning I'm going to pay off my loan with less than the amount I owe. And so the banks were sitting there saying, well, we don't really know because, that's not how this works. Well, so the banks would not do these things. They would not approve that. So the house prices keep coming down and down and down and down. And now it's at the point everything starts to implode. People are going into foreclosure. People are throwing in their houses. They're like, the bank's not approving my short sale. So I'm just going to walk away from my home. So that's why you had a huge glut of houses hitting the market and you had a feeding frenzy. Basically, investors were just buying up properties. They'd go in and offer $100,000 under market price because they're like, okay, if they take it, great. If they don't, I'll just wait another 6 months because that house will come down in value because the market's crashing. Okay, so that's basically what happened in those days. On top of that, here's what also made it catastrophic throughout the whole world is you had these bond rating agencies stamping all these mortgages as AAA rated. So let me explain to you how this all works. So when we do mortgages, if you watch my channel on a daily basis, I go over what mortgage-backed security bonds are doing. Okay, so what happens is when mortgages are done, banks package up all their mortgages into bundles of maybe $100 million or $1 billion, and they sell those bonds out on Wall Street as investments. Okay, well, Moody's and all these other rating agencies, they're stamping these as AAA investment bonds, meaning you can get a higher rate of return on these things than you can anything else, and they're AAA rated, meaning there is basically no chance of default. Well, so investment firms, hedge funds, retirement accounts, individuals are buying all these investments all throughout the world as an investment or an interest, is an investment to get that interest income as an investment. Well, all of a sudden now these bonds are worthless. Nobody's paying and they start to default all over the world. So now you have banks collapsing, you have credit unions collapsing, you have world governments collapsing, you have pension funds collapsing. That's what happened. Okay, so if you doubt what I'm saying, please check out all my information. But what was created at that time, though, was what's called the Dodd Frank Act. It came in and basically put curtailments on all this stuff. So basically, you can't really do a subprime loan anymore. You can't do a stated income loan anymore. In most states, it's deemed illegal. Most states, you can't have a prepayment penalty because it's deemed illegal. And all these programs basically are not even in existence anymore. So if you go onto YouTube, like many people do when they're trying to educate themselves, the first 20 videos of, if you look up real estate, the first 20 of the first 25 are basically just telling you the world's going to crash and this is going to crash and the why is going to crash and don't buy a house in today's market. But if they really truly understood what happened at that time and that those loans are no longer available, you'd have more of a sense of, of a little bit security that if you're buying a house in today's market, you'll be okay because you need money as a down payment. We have to validate your income. We have to do all the checks and balances to make sure you're a qualified person who's buying the house. We don't want you to default. Okay, so that's what is there adjustable rate mortgages out there today? Yes, and they're tons better than where they used to be. They don't have teaser rates. They don't have the interest only options, most of them, and they're really solid secured investments. And you have to put money down on the properties. So again, hopefully a lot of this, after you watch this, please do your own due diligence. I encourage you to do so. If you have any other questions, please put them down below. I would love to clarify this information because I'm coming out with a video in the next week explaining how we found an FHA loan program out there with a 5-year adjustable rate mortgages. It's actually fixed for 5 years. And its rate is about 1% lower than the going rate today on an FHA loan. So I'm going to go through that video with you guys and educate you on how the functions of it work and how it more than secures yourself that you don't get into that scenario where your house payment's going to maybe double or triple. So if you'd like to find out more about me and my team, how we might be able to help you or maybe answer some questions for you, we'd love to help. Just visit us at therateupdate.com. We do something a little unique when you first come to our website and you look to apply to see maybe can I buy a house in this market? The first step you do is you hit the Apply Now button. The intriguing piece of this is we're going to ask you a few questions there. We're going to ask you to set up a consultation call with us because we want to make sure you're informed and you're educated on what you're getting into. And also we can answer all these questions and concerns that you have that you might have been getting in misinformation from, TV and other YouTubers out there to kind of, pull out that disinformation from you and educate you guys on the facts. So my name is Dan Frio. I do a video every day, especially on the economics of real estate, and would love to have you as a subscriber. So if you're not yet, please, all I ask you to do is subscribe down below, give the video a thumbs up so we can help more and more people educate themselves on real estate in 2023 and beyond. Thanks so much for watching, guys. I greatly appreciate it. God bless. Have a great day. Bye-bye.